Well, good afternoon, everybody, or evening or morning, depending upon where you're at. You got John Hopkins here, live from Charleston, South Carolina. Going to be joined by my partner, Tom Bowley, just a couple of minutes. Great to have everybody with us this evening. Got a nice crowd assembling on the, on the day the markets hit new highs. Quite a run here. Sure, Tom will talk about that a little bit. If you're new to Earnings Beats, want to welcome you. Really appreciate you taking the time to stop by and check us out. Hopefully you'll find this session useful. And if you do, we'd love to have you sign up for a free 30-day trial. Be a great time to do it because we've got some events coming up over the next few weeks, including next week, when we'll have the stock selection for the earnings reaction portfolio. We have a Max Pain options webinar coming up. That's for members only. There've been some spectacular calls. And then, of course, our top 10 stock pick coming up in just a few weeks. You'll hear more about those in a little bit. Anyways, I want to let you know that today's event's being recorded, like all of our events. So if for some reason you're unable to stick around for this entire event, no sweat. You'll get a copy of the recording. You'll be able to listen at your leisure. Okay, anyways, I know Tom's got a lot to cover, so let's make sure he's in the house. How's it going, Tom?
It is going well. How are you doing, John?
I know he's in the background somewhere.
Are you there? Can you hear me? Aaron, can...
Okay, I got you.
Okay, there you go.
Yeah, lost you for a second. It was on my end, I think. Well, I'm saying we got a interesting day to do this event. The market's hitting all-time high, just like a freight train. You can't stop it.
No, and this is what we've been talking about for a long time. I mean, we're in a secular bull market. I know there's issues out there. They just keep cropping up one after another. Something's going to take this market down. Wall Street isn't treating it as though we're going down. I mean, we've got consumer discretionary absolutely torching consumer staples right now. That does not happen at a market top. You've got transports now joining the party. That was transports and small caps were two of my biggest, I said the things that keep me up at night. If there's anything out there, it's the way the small caps and the transports are behaving. That this was probably a month ago, because those two should be doing well when the market is expecting a strong economy. I mean, small caps, those are domestic businesses. And then you've got transports. These are companies that are transporting goods, railroads, truckers. That's the US or maybe North America, but at least, we're not talking about places around the world. Railroads and truckers, when they're shipping goods and they're doing well, it should be reflected in the transport. So today, the last 2 days, we are seeing all of a sudden mid caps catching fire, small caps catching fire, transports catching fire. And so they're just joining the party. So it's just one party after another. It's like, being on at a block party, just going from one place to another. That's what's going on right now on Wall Street.
Yeah. If I was a little bit younger, I might think about switching professions. I need truck drivers out there.
Yeah. Yeah.
My problem would be, the biggest problem would be backing up. I'd have to make sure I'm sliding, for each stop. I know you can picture it.
No, I really can't.
All right, listen, I know it's a lot to cover. Like I said, this will be recorded. Going to invite everybody again. You can go right to our site. Tom will throw up I'm sure something on the site. You sign up for a 30-day free trial. There's so much going on this month that it's as good a time as any to take advantage of it. So hopefully you'll give us a try. All right, Tom.
Sounds good. All right, let's jump in here. First of all, thanks everybody for stopping by. Appreciate you taking the time out of your day. everybody's got a lot of things to do, and especially as we get closer and closer to the holidays. So definitely appreciate you taking the time to stop by. As John mentioned, we record all of our events. This one is being recorded. So if you do need to leave for whatever reason, we'll make sure that the recording is available. For those of you that are non-members to Earnings Beats, maybe you're Earnings Beats Digest member. If you're not, and you're coming in here through the link on my stock charts article, we'll make sure we get you added. There's no credit card required. It's completely free. It's a 3 times a week publication or newsletter. Very quick read, just a couple paragraphs in a chart usually, but you can check that out. If you don't want to keep it, you can unsubscribe at any time. We're not going to ask questions, feel free. But I think it'll help in your trading. Hopefully you'll maybe get a little different flavor of trading and investing in the market based on how we look at the market. So I think it's a good thing. So anybody, again, who's coming in here who maybe isn't a part of our paid membership or our free Earnings Beats Digest community, we'll make sure we get you added into that EB Digest community, because that is a free community, free newsletter. I'm going to go ahead and just start and take you all over to Earnings Beats. Start it off there. So make sure I'm set up. I think hopefully everybody can see this now.
Yep, you're good.
Okay, this is our home page. And as John was mentioning, if you want to try our service, our paid service, you can do so by simply clicking on this no-cost trial. It'll go through and give you pretty much an idea of the things that we do for the most part. And then you can join. It's a 30-day free trial. And we'll remind you before the 30 days is up that your trial is expiring. So we're not going to sit back and just wait, and then just bill you at the end of the period. We're going to let you know if you want to keep it. We'd love to have you. If you don't want to keep it, we understand. There's, just because you might like some of the things that I do or say, maybe your style is different, whatever, that's fine. But if you haven't tried us, I think it would probably be a good idea to do so. We do a lot of research, a lot of work for our members. There's a lot of education. Our work really centers around guidance, research, and education. Those are really the 3 pillars of our business. And most of the research comes in the form of chart lists that you can download right into your account if you're a stockcharts.com subscriber, extra or pro member. If you're a basic member, the problem is you only get 1 chart list, and that's your default chart list that they give you when you become a member. So you can't download any additional because you're not at a level where you can take on more chart lists. But if you move up to the extra, which I think is maybe an extra $10 a month or something, I don't know for sure. But anyway, it's well worth it, especially if you're a member at Earnings Beats, because you'll be able to download all of our research, stuff that literally takes me 100 hours sometimes to keep up. The strong earnings chart list takes a tremendous amount of effort. You just take it and download it into your account in about 5 seconds. So anyway, we'd love to have you check this out.
Hey, Tom.
Yes.
Just before you go on, I want to mention a couple quick things.
Yep.
Number one, when somebody signs up for the Earnings Beats Digest now, we have a very, very small survey, literally a couple of questions, just to get an idea of the type of person who's checking us out, what kind of trading they do, size of the portfolio, et cetera. That helps us. And then if somebody signs up for the trial, I personally reach out to everybody, a week in or so, see how things are going, make sure everything's all right. Another week later, let us know if there's any questions. And it's a good way to hear from people. I get, questions about the service, et cetera. So we like to make sure that people get that personal touch.
Okay, sweet. So that's kind of how you get started with us. We'd love to have you. But tonight's event is completely free. It's a sneak preview of our earnings reactions portfolio event, which we'll have next Wednesday, where we'll actually draft and select the 10 equal weighted stocks that are going to be in this portfolio for the next quarter. Now, if you're somewhat familiar with us, obviously, if you're a member, you know what's going on. But if you're kind of been watching or whatever, we have 4 stock portfolios that we've been tracking for, model portfolio now for about 3 years, which has tripled the S&P 500 over those 3 years. I think model portfolio is up about 220%, and the S&P 500 is up 73% over the same time period. We've had maybe not quite the same results, but still very strong results in both our aggressive and our, I'm just going to go back to the home page so I can kind of show you where, if you come into earnings beats, this is the home page, and you scroll down, you'll see there's where you can subscribe, but we'll make sure you get subscribed. But right next to it here is the success that we've had in terms of these portfolios. And so this is as of yesterday's close, but you can see here's the model portfolio since its inception on November 19th, 2018. This is what the S&P 500 has done over the exact same period since November 19th, 2018. So you can see how these portfolios have performed relative to the S&P 500. The aggressive has more than doubled since May 19th of 2019. So 2.5 years, up to 135%, whereas the S&P over the same period up 62%. Strong AD, this is just for a year and a half, and it actually started after the pandemic. It started as a result of the pandemic, to be honest. But anyway, that's up 87% versus the S&P's 58%. The only stock portfolio that we have trailing is the income portfolio, and our return here does not include dividends, which wouldn't make up for the difference, but it's probably, 2 or 3 percentage points, maybe a little bit more than that. So I'd say all in all, these portfolios have done very well. And what we try to do is put in leading stocks and leading industry groups. Well, back on August 10th, you don't see the strong or the earnings reaction portfolio on here. And there's a reason for it. We just started it August 10th, and we're kind of testing it. We want to see, whether or not companies that are being heavily accumulated or appear to be heavily accumulated after their earnings report, we want to see how they go on to perform later on. And so that's what we've been tracking. I can tell you through today's close, which I just updated a few minutes ago, our earnings reaction portfolio since August 10th is up 7.77%. The S&P 500 is up 5.04%. And I'll go over here and show you, there were 2 of the companies in the 10 that reported earnings after the bell. One is SITM, stock's up 6.5% right now after earnings were reported. So clearly it seems like some accumulation taking place there. And then Fastly, which is up about 5% right now after earnings. Both of these are in the current earnings reactions portfolio. Next week, they may be out. They probably will be out, and we'll be putting 10 new equal weighted stocks in that portfolio based on the same criteria we used 3 months ago. So that's kind of the lead in for what I want to talk about tonight, which is the earnings reaction portfolio and our strategies and so forth in deciding which stocks are going to go in this list. What are we looking for in this earnings reaction? What does it even mean? What does earnings reaction mean? Well, for us, the definition is once a company is reported, whether it's reporting like tonight or tomorrow morning, the opening bell tomorrow will be the first time that the stock market will be open after they've come out with this new information. And companies get reevaluated or revalued all the time based on more current fundamental data. I mean, if a company is raising guidance, then you've got to change your models going forward. You have to raise your, percentage, your growth numbers in your forecast, and then discount that back. Those future earnings, you discount them back. And I'm just saying the way the big firms are going to do it to come up with what you think is a good solid value. So when a company beats earnings and then comes out and raises guidance, that's when many times you'll get upgrades on companies and so forth. But what we did in this particular exercise with earnings reactions portfolio is we wanted to see when a stock opened for trading the next day or right after its earnings were reported, how did it trade from the opening bell to the closing bell? Because it's going to have one of its biggest volume days of the year. Any stock that goes up from its open to its close, I think we can assume that there were more buyers and sellers and there was accumulation taking place. And if it goes the other way, if it goes down from the opening bell to the closing bell, then we're looking more at distribution. So this portfolio was selected from the best of the best in terms of going higher from open to close. That's all we looked at in calculating the performance and the potential accumulation, if you will, of these various stocks. So as you can imagine, we're looking at literally thousands of companies that are reporting and finding the best ones, best stocks in terms of their earnings reactions. Now, we bought all of them as of August 10th of this year. Didn't matter whether they were at a support level. We looked at the companies that we liked the most based on their earnings reaction and the apparent accumulation. And then on August 10th, we announced it. We, in theory, bought at the close on August the 10th. And we will sell at the close this August 10th. So we have another week. And next Wednesday after the close is when we will announce the next 10 equal weighted stocks that are going to be in this portfolio. So this was kind of a test run for the first month to see if this is something that we believe could be an outperforming type of portfolio as we go forward. It makes sense to me that some of these companies that are being heavily accumulated after earnings will continue to go higher. Not all of them. And in fact, I'm going to go ahead and bring up the individual stocks here in just a minute. But I want you, this is the chart through today's close. The top part of this chart is the earnings reaction portfolio, starting right back here on August 10th, starting at 100. And currently it's at 107.77. If you're familiar with the, I'll go back over here for a second. If you're familiar with the user defined indexes right here, this is how I keep track of this. So every day, for instance, I will go in and on the earnings reaction portfolio, I literally just updated this week. So 11.1, 11.2, and 11.3. And I have an Excel spreadsheet that tracks each stock. And every day I go in there and I put their closing price in and recalculate what the portfolio is worth. And so this is then used to generate this chart. So here's 107.77. And then if you look, that's what we have here on the chart through November 3rd. The S&P 500 over the same period, starting out at 0% back here on August 10th, has risen 5.04%. So we are outperforming right now by about 2 3/4% with 1 week to go. And as I just showed you, two of the earnings out after the bell today were both very strong, SITM and Fastly, FSLY. So I expect that we'll get even a bigger pop tomorrow in our portfolio relative to the S&P 500. But we'll see how we finish at the end of next week or at the end of this period, which will end next Wednesday. And then we'll go through and do our process again and reevaluate again. Now, looking back, this isn't going to be perfect because this is all 10 stocks that we included in this portfolio based on how they reacted to earnings last time. And this goes back 3 months. So technically it should be 1 week less than 3 months, but we don't get that option. This is one of the things I've actually asked for over at Stock Charts in the past was it would be nice if we could just, for the period, set dates. So I could go in and say, give me, this portfolio from August 10th through now. And then it would be able to spit it out exactly. That would be ideal. But I know Stock Charts they're doing a lot of different things. So they prioritize the different projects, but that would be pretty cool to be able to change this period to set it to whatever days you want it to start and end at. But you can see over the last 3 months, which is going to be pretty close to what we looked at. SITM up 99% in the last 3 months. EXPI, this one got hit the last 2 days. It was $55 2 days ago. Now it's $45. So it's up 32%, but it's come down quite a bit in the last 2 days. Then you've got Dexcom, which is a medical supply company, and then you got Fastly. Fastly, 15% is probably going to go up a little bit more based on its earnings report, and this SITM is going to shoot up even further based on the way it's trading in after hours. But you can see that the S&P 500, which was up 5.04% in the last 3 months minus a week. So that would come in roughly here. So you can see not every stock beat the S&P 500. We had losers in here, but by equal weighting it, 10 stocks, what we're looking for is to try to get outperformance based on the entire portfolio over time. It's not going to happen every quarter, but after the results for the first quarter, I think definitely tells me that we have something here to at least continue looking at and, doing another draft next Wednesday, getting the 10 stocks in here, and let's track it for another quarter and let's see how it does. I like to trade a lot of these stocks. I don't just buy and hold these stocks. I know many of you do. I know my daughter who works with me here at Earnings Beats. She's into the model portfolio that we do. So she invests for the entire period. Because I always get a question, do you put your money in these stocks? Well, I do trade them a lot, but I don't buy and hold for 90 days because it's just not my style. We actually created these portfolios because members that didn't want to trade every day were saying, what can you do for us? How can we apply some of those principles at Earnings Beats, but not sit in front of a computer all day looking at stocks? And so that's how these portfolios were born. It was basically, let's find some of the leading stocks and leading industry groups. We'll diversify to some degree. We're not going to put all 10 software stocks in a portfolio. That would not be very smart, especially if software happens to have a bad quarter. But we'll diversify and, see if we can outperform the market over time and demonstrate to our members how we do it. So we've been doing this now. Like I said, in the model portfolio, it'll be 3 years on November 19th. So I think we've got a pretty established track record at this point. We've been through the trade war. We've been through the pandemic. And we've come out of it after 3 years up 218%. I'd say that that's pretty strong. Anyhow, you can judge for yourself, but this is how we, come up with these, or this particular portfolio is by using as our primary filter. Our primary filter is how stocks perform the day after they report. One day, I just want to see that candlestick. Is it a big hollow candle where it opened low and finished near its high and did it on massive volume? If so, I'm making a pretty sound judgment that the stock was being accumulated, which I think bodes well over time for a stock like that. If the stock opened at, say, $50 and traded down to 45 by the close, then it's going the other direction. I'm not interested in that. Maybe if I wanted to short the stock, but I don't short stocks in a secular bull market. Try to short this market right now. I mean, good luck. You might be able to find a couple stocks here and there, but for the most part, I mean, look at Tesla and some of these other companies that literally are just going up day after day after day. And people are saying, how is this possible? How we got a pandemic, we got all these issues, we got debt, we got, oil prices jumping. A lot of people want to try to bring politics into all this. I ignore all that. I look at the charts. That's all I look at. And the charts are telling me that this market ain't done. And it ain't done by a long shot. Now, we are going to have some difficulties along the way. We're going to have periods, just like we had during the pandemic, maybe not quite that bad, but we'll even have probably a cyclical bear market or two or three over the next decade. But I think the stock market's going a lot higher. And I think it's as simple as the choice that we have to make between asset groups, asset classes. You got stocks, you got bonds. So you got bonds. You want a 1.5% bond, or would you rather ride Apple, which is exploding its earnings quarter after quarter? That's the choice Wall Street managers are having to make. And guess what? They're choosing the stocks. And if they're choosing stocks, I'm choosing stocks. I'm sticking with the crowd in terms of the smart money. All right. So this was the 10 stocks that we picked last quarter. So let's take a look at what we've seen so far in this earnings season. And I'll show you what I mean here in just a minute. But let's pull up, bear with me 1 second, because I got to switch out my charts for my Excel spreadsheet. All right, so I am going to give kudos first to one of my friends and one of the guys who works with us at Earnings Beats, Matt Townsend. Matt's been working with me a lot on a lot of the analysis that we do, watching different chart lists, watching different stocks, using Excel to track a lot of different things. So Matt did this for me, so I will give him the credit here. But essentially what we did and what we've been doing is since earnings season started back in middle October with all of the banks and so forth, from that point forward, you can see the dates here. I could sort it in that order if you wanted, but I mean, this is how many companies that we've already looked at. I mean, we're down now to 364 rows on Excel spreadsheet. And this isn't all the companies. This is just companies that have market caps over $1 billion. So we stop at that threshold. There's a lot of companies that report below that threshold. And we're, believe it or not, today and tomorrow are the two biggest days of earnings season in terms of the number of reports that are coming out. I think tomorrow we have like 570 companies that report earnings. So this list is going to grow immensely between now and next Wednesday. So I wouldn't be looking at this saying, oh, these are the stocks that are going to be in the portfolio. Because number one, it's not that easy. I don't just look at the percentage. This yellow right here, open to close AD change. This is what I'm focusing on for this portfolio, just this portfolio, not the model portfolio, not the aggressive portfolio, income or strong AD. This is only for our earnings reaction portfolio. All right. So this is the primary filter that we want to use. So for instance, Avis Budget, did you see that yesterday? They reported Monday after the closing bell. Yesterday, this is a company that also is fairly heavily shorted, and they came out and blew the numbers away. The stock ran from 170 to 550 intraday, but it opened at 174 and it closed at 357. So from 174 to 357, that's $183. So it's a little bit more than 174. So it went up over 100% from its opening price. And there it is right there, 104.92%. Now, I may or may not include Avis Budget because this wasn't necessarily all accumulation. This is where judgment starts to come in. I'm looking at this and saying, yeah, it was a heck of a move to the upside. But you remember GameStop back in January when it broke out and it went absolutely crazy from $15 to $500 in a week or 2 weeks or whatever it was? That wasn't based on fundamentals. That was based on the fact that there were so many shorts out there. You had a lot of short covering. So part of this is going to be short covering. And I'm probably going to just watch it for the next week and then I'll make a decision. But after making that huge a run with all the short covering, I think that's very, very risky to put 10% of a portfolio in that stock right now. So I'm going to have to kind of watch that one. And then you'd be holding it for 90 days too. So think about GameStop and how it just slowly kind of went down and over a period of time after it had that big move up because of short covering. But beyond that, we've got a lot of other companies here. Let me I'll try to make this a little bit bigger for you so you can see these. So let's see what else we've got. And I'm going to just kind of, on my other screen, I'm going to take a look at the charts as I go through these. And okay, so the first one here is CACC. So here's your open to close AD change, 14%. That's pretty big. Last quarter, by the way, the biggest one was about 20%. And I didn't pick it. And I'm trying to think why I didn't pick it. Well, I know why I didn't pick it. I'm trying to think if I had left this open, but I did not. Maybe I can go look for it a little bit later and pull it up for you. I'm trying to think of what company it was. But essentially, when I looked at the chart, because I do a little bit more research, I just don't take, I don't just take this percentage and think, okay, that's the percentage. That's what happened. It was being bought all day. Sometimes there are errors made in the market and stock prices are reported improperly. The biggest gain last quarter, when I looked at the stock, it literally went down at the opening bell like 20%. And if you looked at a 1 minute candlestick for that day or candlestick chart for that day, at 9:30 in the morning, it opened down 20% and then came right back up to the open. And there was almost no volume. So that was just a reporting error or something. I mean, that's not accumulation. You can't accumulate if you don't have volume. So I threw it out. It's like, that's, yeah, on the surface, it had 20%. It was the #1 stock. But when I pulled it up, looked at the chart, it was not something that I would be investing in. So this is the starting point. This is not the ending point. I don't look at this and say, give me those top 10 stocks. I look at them and then I want to look at the chart and see if I actually believe the story that this column is trying to tell me. I want to look maybe a little bit at the AD line. I want to look at the chart. Like Fastly was not, top 5 last quarter. But when I looked at the chart, I was convinced that we had an exhaustion gap when they came out with their earnings. They opened at 35 and they ran up to, 40 something. And I thought with that huge hollow candle and the massive volume that was in, I said, that looks like an exhaustion gap. We never went back below that 35 level on Fastly. And now earnings coming out tonight. We'll see what happens tomorrow, but at least after hours. And by the way, it was up 20% earlier, Fastly. It was at $63 from the 53 close. And when I pulled it up and was showing it to you, 56 or 57 bucks or whatever, it's down $5 or $6 from where it was when the earnings first came out. So we'll see. This could be a volatile one for tomorrow. Fastly, FSLY. But I've been talking about Fastly for a while. I was doing the pitch, one of the shows over at Stock Charts, probably about 3 weeks ago. And you have to give 5 ideas. Fastly was one of my 5. The stock was trading at low 40s, I think. And I even mentioned that if it went down, as long as it didn't go below 35, it would be fine. And I think the next couple of days, it got down to as low as about 38. Then it's come back to 53. And then the earnings came out. One of the other stocks I picked was Tesla. And then I also picked the IYT transport. So those 3 have been off the charts, really, really solid. And I think 4th one was Open Door Technologies, OPEN, which has had a rough couple of days here of late, but has done very well since mentioning it on the pitch. Anyway, I digress there. When you look at this is the filter that I start with. So yes, I am absolutely going to start at the top, work my way down, and see which of these stories I believe. The 10 stories that I believe the most are going to be the 10 that end up. And it could be, I think I said that I wanted a minimum of 4%. So based on that, I would cut off right here. So this ASB, which is a bank, up 4% from its open to close that day after earnings. So from there all the way up, these are the ones that I would be reviewing. And between now and next Wednesday, we're going to have a ton more being added here. So we'll be looking at these every day. And if you all aren't familiar with the upcoming earnings chart list that we generate, that's not something else that Matt helps me with. We do that every single day for our members. So for instance, all the companies that report today after the closing bell and all the companies that report tomorrow morning before the opening bell, all of those companies go in one chart list. And so when the opening bell rings tomorrow morning, you can literally pull this chart list up at say 9:31 or 9:32, and you can get the reactions and sort it in performance order from best to worst or from worst to best, whatever you're looking for. It is so awesome to organize all of these companies that are reporting in one chart list. And another request I have into Stock Charts, hope nobody at Stock Charts is listening because now they're going to probably not be happy with me. But another thing I'd love to see Stock Charts be able to do is to, in a chart list, when you pull it up in summary form, be able to show me pre-market and aftermarket hours quotes, pre-market quotes and after hours quotes on a chart list in summary form. Because then I could literally be looking at them at 9:20 or 9:25 in the morning and start planning any trades that I might want at the opening bell. Sometimes I see stocks, they come out with great earnings. And I'll give you a perfect example today. Solar Edge, a renewable energy stock. They came out, they beat their estimates. The stock gapped down after rising recently, and then it printed a really nice hollow candle today. Great opportunity. So sometimes when stocks gap down at the open, they create opportunities for trades. Or if they gap up, you might want to just take your profits if you held into an earnings report and you're fortunate enough to get that positive reaction. But anyway, these upcoming earnings reports are awesome. So if you don't already use that, we have a link every Monday, Wednesday, and Friday in our Earnings Beats Digest newsletter. So it's available to everybody, even our free folks, our free community. You can go in and download those chart lists and have them available. I can't even begin to tell you how many times I've had successful trades off of those upcoming earnings chart lists. And we do it for you every day. So on Sunday night or Monday morning, they'll be on the website ready to go. So you can download the whole week's worth of chart lists. So anyway, again, we streamline a lot of that for you. That's part of our research, part of what we do. All right. So now looking at this list, I'll tell you what I'm going to do. I'm going to take down maybe the top 10. I'm just going to jot these down. Or maybe what I'll do is I'll start a new chart list. Can I do that? I think I can do that okay over on here. Yeah, so just bear with me. This will probably just take me a couple minutes, but I'm going to set up a new chart list and I'm going to list the companies, maybe the top 15 here, and then we'll pull the charts up. I'll switch back to charts and then you can look at the charts with me and I'll kind of walk you through what I'm looking at. So let's see here. Let's go with all right. I'm sorry, I'm just titling my chart list. Okay, so I'm going to enter all of the, let's see, we'll start with right at the top. So I'm going to start right here. And I'm just going to work my way right down that list. So CAR, CACC, SKT, RUSHA, LDI, ARNC, MTRN, ARCB, AVNS, OLN, AMG, IPGP, WTFC, Pool. We'll do a few more. CLF, Alcoa, Extreme Networks, TCBI. Might as well just go down to where I can't see anymore. AMRC and UFPI. All right, so these I'm just going to go down right down to this. So that'll give me down, it looks like 21 different stocks. So I'm going to add all these charts in, and now I'm going to take this down. And by the way, this, once we complete the earnings reaction spreadsheet, this is just one tab that I'm working on right now, but we have a lot more information. We actually break down all of the earnings reactions by sector, by industry group. I mean, it's phenomenal, the information that we can get from, and just seeing how, you know, which areas of the market are being accumulated, which ones are being distributed. It just helps us to give us that background knowledge when we go to trade. So once we get all of this done, and this, again, this is just one small piece of the entire spreadsheet, we'll make this available. We make these downloads available to all of our annual members. And the reason we don't do monthly, I mean, it takes a lot of work. I mean, it's a lot of commitment on our part to go through thousands of reports and to put together these spreadsheets. So we do it, you know, if you're going to be committed to earnings beats, then we're, you know, very happy to share this information. And by the way, just about every member of Earnings Beats is an annual member, because we make it so that the monthly membership, or the monthly cost by purchasing an annual membership, is half the cost of just going along regularly and paying monthly. So if you make that commitment to us, we're basically going to give you 50% off. And then any of this research work, like, you know, this spreadsheet, we provide our members. We do a lot of this type of work where we will provide a lot of our research to our members. And then you can take the information and do with it what you want. If you enjoy working with Excel, you will find a tremendous amount of information on these spreadsheets. But anyway, let me go ahead and switch out these again. And so all I did was I set up this earnings reactions Q3 chart list. And then I just went down here to the bottom. And once it was set up, I just clicked many and I just typed in separating them by a comma. And then here they are. Now, next thing I would do is, how do I want these set up? So right now I'm looking at Alcoa, but it's got a PPO. This is my default chart on this particular account that I have with stock charts. So I have a PPO, I have the candlesticks, price action, moving averages, my volume, and then I have RSI. Well, this is based on accumulation distribution. I definitely want the AD line. So what I'll do is I have these chart style buttons set up, and I have a relative strength with AD line style button that I click on. And now you can see I've got PPO, I've got the price action. Now I've got the accumulation distribution here. And then I've also got relative strength charts down here that I want to be able to look at. Once you decide, okay, this is what I want to look at, then what you do is you come down here and you hit apply style to all. And this will change the style of my charts on every one of the charts within this chart list. So all 21 stocks have now just been changed. So now when I go to the next chart, AMG, I've got it set up the way I want. So just a little tip there at stock charts, pretty cool feature. All right, so now the question is, which ones of these stocks are potential stocks that I might want to include next week when we announce the 10 new ones? And so if I go back here to the beginning, well, they're not in order. What I do is I order them based on the percentage. So for instance, the number one was CAR. So I would go in here and I would hit edit, and I'd go down to car, and I would just, let's see here, 001 car, save changes. So I'm not going to do that because it's going to take up time and waste your time. But once I have the list in order, I order it in my chart list. So I know when I'm looking at 001, I know this is the best percentage gainer intraday after earnings of every company that we looked at during earnings season. So I know all of these are good, but I don't have the order. So I'm going to start from the top when I do my own research, but I don't have that luxury right now because I don't have them in number order. But anyway, let's take a look. Here's car. So this is where it ran up. So 175 to 550-ish before coming back down. Then it gaps down today. It's 298. I don't know. Honestly, I don't know if this was more short covering and now you're going to have more shorts jumping in, kind of like we saw with GameStop. Where is this company going to be 3 months from today? Man, I have no idea. I mean, 225, considering where it was 2 days ago, 225 wouldn't be bad. But if we put it in the earnings reaction portfolio and it's down $70, that's going to be down more than 20%. I'm not going to be very happy to have that as one of my portfolio stocks. So the problem I'm going to have with this one is I'm just going to not be sure about the risk. The risk just seems so great. It could be back up to 500, but it also could be back to 200. And I just don't know. So, you can say that about any stock, but this one, I think by looking at the chart, you can probably tell it's definitely a little different than most charts. Seeing that run up to 500 yesterday, now today it's down as low as 288. And 2 days ago, it was 175. I mean, I don't know where this thing's going from here. I wouldn't trade it. I wouldn't own it. So anyhow, I would pretty much, I can probably tell you that's not going to be on the portfolio next week. All right. So then Alcoa. Now Alcoa made a pretty nice run. There's the candle that got them on the list. So Alcoa was, I'm looking down at my other screen here. Alcoa ran 7.86%. So from the opening bell here to the closing bell, the distance between, in this hollow candlestick, the bottom line or bottom part of the rectangle, that's your opening price. The top part of the rectangle is your closing price. So that distance is 7.86%. Now, since then, it's pulled back and actually came back down to a pretty good area on the chart. Got some pretty good support around 45. So this would be one that from a trading perspective, buying it at 45 near support after it already came out with new earnings information that the market seemed to like. I would be okay with that, but it might be one that I'd want to keep a stop in play. And if you follow us at Earnings Beats, when we put these portfolios together, we want to keep them, we want to make them transparent, and we want to keep them simple. And so we don't want to be trading in and out, because remember, these portfolios were originally put together for members who don't want to stand in front of their computer and look at stuff all day long. So we're going to hold our portfolios. We're going to hold every stock for 90 days. We are not going to use stops. That doesn't mean that you can't follow them or trade them and use stops, do whatever you want with them. I'm just saying, for our purposes, in order to keep it simple, keep it transparent, I don't want to look back and say, well, 2 days ago, we actually made a switch because we didn't like the way this stock was acting. We went with a different one. And then trying to keep track of that and getting that information out to all of our members on a timely basis with all of our portfolios. If we did that with all of our portfolios, my gosh, I think I'd probably be in an insane asylum. I couldn't keep up with it. There's just too much. So I'm just telling you and letting you know right now, when we announce these next week, I don't care if we put AA out and it goes right down through 45 on heavy volume. It's going to be in there for 90 days. Now, you can put a stop in your account if you want to trade these, whatever, completely up to you. But I just want to make sure everybody is aware. The other thing I want to make sure everyone's aware, and we always try to cover this at some point during our webinars, but I am not a registered investment advisor. No one at Earnings Beats is a registered investment advisor, and Earnings Beats itself is not a registered investment advisor. So we cannot provide investment advice. That's not what we do. We provide research, we provide education, and we provide guidance. I view these portfolios as education. We're trying to teach folks how leading stocks and leading industry groups can generate returns greater than the S&P 500, especially when we're in a secular bull market. We try to educate our members about all of those types of things. As far as stops and when to use stops, that's completely up to each individual. I can't possibly look out over our entire membership and successfully tell everyone what they should be doing in their account, nor would I want to. But everybody's different. Everybody's got different risk tolerance levels. You've got different objectives. What are you trying to do? You're at different points in your lives. Some of you are probably retired, really not interested in these high flyers. Others of you might be in your 20s or 30s and basically saying, give me all the high flyers. That's exactly what I want. There's no way I could provide guidance, well, not guidance, but individual stocks to our membership and feel like it's a responsible way to do things. I know a lot of our competitors do that. I don't understand how you can do it when you have such a diverse group of members. So we try to educate, and then all of our members can take from that and figure out how this all fits into your own plan. So AA, like I said, maybe it's in there, maybe not. Volume was really good on that day. So you can look back, you can see that was the biggest volume of the year when it went up. That to me means accumulation. And it even went up next day on some pretty decent volume. So this pullback, maybe it's an opportunity. But again, that support level is pretty critical around 45 in the short term. So I'd like to see that hold. All right, next one. Hold on one second here. All right, so next up, affiliated managers. Now, the other thing I didn't show you on Alcoa, but I can show you on these others, is I'm looking to see what their industry groups are doing. So AMG, affiliated managers, right here, this company is part of the asset managers group, which is breaking out to new highs. But I also want to know on a relative basis how it's doing. Well, it's breaking out to new highs versus the S&P 500. So you got a strong group. How is AMG relative to its peers? Well, it topped back 9 months ago, and it was pretty close to that level again about 4 months ago, but it's been trending lower. But since earnings came out, you can see it's actually started to outperform its peers again. So this is a pretty good stock in a pretty good area of the market. I mean, I don't know that I would say it's a leading stock. There are probably other stocks in this space that are better, but with its earnings, it definitely showed some nice improvement. The volume would concern me a little bit because it's only about 700,000 shares. And you can see many other days during the year were much better. I mean, here, look at this move up with that massive volume. And look at what happened afterwards. Kept going higher and higher. Next up, AMRC, Amaresco. And by the way, we'll probably wrap this up the next 10 or 15 minutes. Just going through these charts, I'll try to pick up the pace on the charts. AMRC, I can tell you, probably will not be included because I'm just not seeing any massive volume. I'm not even sure which day they reported. That's when you really have to question whether or not there was a lot of accumulation. I can't even tell which one of these days. I mean, I can look at my spreadsheet, but looking at the chart, you should be able to tell which day was the big volume day from earnings, and I can't really see it. It's a great looking chart, don't get me wrong. This is in the DJUSHV, and that is the heavy construction. I should remember the heavy heavy construction area. And if you look, heavy construction topped, it had a 52-week relative high back in May. It's just kind of going along for the ride right now. So it's, as the S&P goes up, this one's kind of going up with the S&P. That's what's been happening the last 2 months. So here's your breakout of the stock relative to the S&P. Here's your stock breaking out relative to its peers. So this one does give you leadership. The stock is a leader in its space, but again, without the volume, I probably would pass on this one. So I'm going to be going through all of these stocks that are over 4% accumulation numbers for the day after earnings. And I'm going to try and pick out my favorite 10. And I'm going to try to diversify as best I can as well to get them in different sectors, different industry groups. And then we're going to ride them for 90 days. So next up, ArcBest. This is in the trucking area. I like transportation. I really like transportation right now. Transports love the month of November. And if you look at this, look at what's happened here in November. We've made the breakout, volumes expanded. AD line is going through the roof, which is great. Trucking going through the roof on a relative basis. Trucking just broke out. And this is one of your leading stocks in the trucking area. So could this one be on the list? Absolutely. This one could be on the list. This one would make the first cut for sure. Usually what I'll do is I'll go through the whole list and try and narrow it down to like 20, 25 stocks, and then I'll pick the 10 from there. I would say this one's probably going to be in those 20 or 25. ARNC. Well, I'm assuming that's the candle right there, which is a very nice candle. Now, if I was convinced that this downtrend was over and I saw that, and I saw massive volume, which I don't see, I see about 1.3 million shares, but I see a whole lot of days during the year more than that. Here was probably an earnings right here, beginning of May, and look, the volume there was 3 million. So that to me looks much more like accumulation. Didn't go a whole lot further after that though, but basically went sideways for the next few months. This is in the diversified, the industrial suppliers. That's what it is. DS is your industrial suppliers, and that group is broken out. But on a relative basis, well, it's been doing better on a relative basis. Just about 45 days ago, it was at a 52-week relative low. So the group is beginning to gain some strength here, probably because we're into a sweet spot historically. The November timeframe for industrials tends to be very strong. But is that going to be enough to get it into my top 10? Probably not. I don't like, I really want to focus on strong volume. I mean, that volume, I should be able to tell that there's some serious accumulation going on. I can't really see it there. Next up, AVNS, Avanos Medical. All right, now this one gapped down with earnings. I'm assuming that was the earnings run right there. And I can double check that just to make sure. Let me just see. AVNS opened 30, closed at 32.65. Yeah, so that's that one right there. So it gapped down. Volume, if the volume was heavier, I'd feel a little stronger about it. Now this volume right here is skewing everything. I mean, this wasn't bad volume, but it wasn't the strongest on the chart. But still, that kind of reaction is a nice reaction, running from $30 to $36 in 2 days on good volume. tells me there's probably some accumulation taking place on the stock right now. Credit Acceptance Corp, CACC, there's a big move. This one doesn't trade much volume though, on a regular basis. To me, this one isn't what I would consider liquid enough to put out there for our members. Just because if everybody's getting in, or if a lot of folks are getting in, and you've got, the stock trading under 100,000 shares some of these days, I just don't think that's a prudent way to get in. I mean, if everybody's trying to get out at one time in a stock that doesn't trade many shares, that would be hard to do. It would be hard to get out. Cleveland Cliffs, there's your earnings right there. There's a nice little move up. This one kind of looks interesting. Maybe a little cup off of this long uptrend. Little cup, maybe a handle down to the 22 level. This one's kind of an interesting one. I don't know. Maybe it makes the cut, maybe not. Just kind of have to see what else is out there. Extreme Networks, I like the move. I'd like to see the breakout, but there's a much heavier volume. That one looks a little bit better than some of the others. We'll see. This is one that maybe will be under consideration a little bit. Fulton Financial, FULT. I think that's the earnings right there. Most of these financials reported back in the middle of October. But let's see, FULT on that spreadsheet. Opened at 1588 to 1707. Yeah, so right there, that's the candle. Volume was okay. There's your banks, but look at the stock relative to the bank index. See, I would toss it. I want a leading stock. I mean, I want a stock that at least is a little better than that. I don't want to jump into a stock that is showing relative weakness, because that doesn't paint a picture of accumulation. I don't care what, and the AD line actually is down near 52-week low. So that combined would take me out of this stock. I wouldn't be interested. So even though it had a nice candle, it gets thrown out. IPGP, nice move on the 2nd of November there. Downtrending, again, relative strength. It's in a pretty good group and it's near 52-week low. Probably not, unless, I might be looking at this next week and maybe I see some other things. Maybe I pull up a weekly chart and I see a positive divergence on a weekly chart. There could be a lot of different things I look at between now and next Wednesday, but I'm just trying to walk you through and take a look at some of these things. Now, LDI, this is Loan Depot, been going down for many, many, many months, was $37 9 months ago, and now it's down $6.83. It's lost a lot of ground. AD line continues to tumble. Relative strength is weak. Probably not interested on one day. And even that day, look at how far it finished off of its intraday high. That won't even get you a positive number on the AD line. See right here? That particular day, the AD line barely budged to the upside. And the reason is the AD line doesn't calculate where you were yesterday and where you are today. It looks only at where you finished today relative to your high and low. If you're right in the middle, it's going to do almost nothing to the AD line. If you finish at the top, it's going to add all the volume. If you finish at the bottom, it's going to subtract all the volume. That's how that AD line works. All right, MTRN, big move up, but volume just not heavy enough. I would pass on it. OLN, pretty decent volume there, a breakout. Accumulation distribution, okay. You got a leader in the space. The group looks like it's trying to break out. If it actually breaks out and you got a leader, this one could be an interesting play. This would probably make the initial cut. Pool, this is SCP, Pool Corp, breaking out. There was the candle that did it. Volume not heavy enough though. Probably I would pass on it. RUS, I can look at the volume and just pass. SKT, volume's better than it's been probably for the last 9 months since that, this period. And it did just make a breakout. It is in the retail REIT area, which is just broken out. AD line, not so great. Relative strength, strengthening here recently, kind of so-so. I don't know, probably pass on it. TCBI, not really looking at it here, not liking it. Again, look at the relative strength. AD line starting to strengthen a little bit, but probably not. And I think this is the last one, UFPI. Oh, I've got one more after this one. So UFPI, definitely strengthening. There's the candle. Again, volume so-so. I think probably a lot of them that we end up selecting will likely be over the course of the next week, that report. So we'll see how they do. There's your Wintrust Financial. There's your move. Pretty good volume on that one. And here we actually see the banks going up, and this is the stock actually leading. So if I decide that banks might be a spot where I want to be, this could be a stock that I would consider. This probably would make the first cut. Anyway, that is essentially what I wanted to go over. Again, this is just a preview, a sneak preview of what we're going to do next Wednesday when we actually select the 10 stocks that are going to go in that portfolio for the next 90 days. What I will probably also do and provide you is, like, if we did this, if WTFC, for instance, is one of the stocks that we ultimately put into the portfolio, I will likely annotate and I will show you where I would be watching the stock, because we would get in as of whatever the closing price is on August 10th, but might say, hey, a better entry would be if it ever gets back and tests the top of this gap support right here at 85. So we might get in on August 10th at 93, but if the stock were to pull back to say 85, that would be a much better entry. And I'll show you where, this comes into play, because last quarter we had Fastly. And if you look, here was your gap support. And I mean, we never tested it, but to me, the biggest number on this chart was right here. And you see the volume being the heaviest volume of the year with that hollow candle. That's the reason the stock got picked. It had been downtrending. I also looked at the weekly chart, and I really liked $35 as support on the weekly chart. And so it's now starting to turn back around. I think we're going to make a run for the low 60s. Eventually, I think we're breaking out. I think Fastly is beginning to show some relative strength again. And as a result, I would say here's the move. We're probably heading into earnings. And then tomorrow, if the gap up that we were looking at after hours remains in play, we're probably going to be moving up to about a 4-month relative high on Fastly versus software. So this is one, we'll see how it does tomorrow, but that was all based off of what I thought was accumulation 3 months ago. And it was telling a story. This one was not a great performer back then. But looking at the weekly chart, here we gapped down, went back up, and here we gapped to new low. And instead of going lower, we actually started going back up again. So Fastly just gave us a little bit different look. So that's what we're going to be doing. We're trying to find 10 stocks that make sense for us to put in this portfolio. And then we'll try to outperform the S&P 500 again with it. So that's what I have, John. Took about an hour. I don't know if we have any questions.
Yeah, here's a couple. Somebody's, sort of commenting in the fact that in the past, there's been times when, the Fed's come out, you had a nice rally, and then before you know it, you get a little bit of a sell-off. And wondering in particular with, made note of the put call ratio that Stock Charts provides, that is in the 3s. Do you have any worry in the near term? And if so, do you think it'll just be short term?
Well, there's what we're talking about there. I think it's short term. First of all, the put call ratio is really important, I think, when we get close to max pain, which we have a session it's the Tuesday before the third Friday. We do this every month at Earnings Beats. And the whole purpose of that is to look to see which companies might get hit as a result of too many, an imbalance of calls versus puts. And so, yes, I do use it mostly for that. But yeah, I also pay attention to the fact that, when it's starting to get down and it starts setting, sometimes what I'll do is I'll use like a 5-day moving average. So instead of candlesticks, if you've never used this before, you can do it invisible. Now, if I just get rid of that, now you see all of the that daily stuff went away, and all I see now are the moving averages. Well, then what I'll do is I'll get rid of my moving averages, and my simple moving average, I'll just turn it into like a 5-day moving average. And you can kind of see when it gets down to this level in here, 38 to 40, yeah, we could have potential problems. For a period of time, I would say a brief period of time. But I think using this chart, I think that the CBOE, this put call ratio, does a much, much, much better job of marking bottoms when things get bearish That's when this ratio gets up here. I think it does a much better job of marking bottoms than it does marking tops on the S&P 500. So,
All right.
yeah, I'm paying attention to it, but I'm not going to be worried about the next 3 months because of the reading right now.
Okay. Fastly and TDoc had the same behavior when they reported last time. Why did you pick up Fastly instead of TDoc?
TDoc that is part of the portfolio.
Okay.
Well, let me get back to a regular chart here. TDoc, yeah, that candle right there is the one that, and look at the volume. And this is just a company that I happen to like. So when I saw that for 2 days, and then it was up here around the 10th, I mean, it actually was doing pretty poorly in this portfolio for the last couple of months, but then started picking back up again. And we just got another one. I would say if I had to pick, or I had to make a pick right now of one stock that's likely to be in the 10 next quarter, I think Teladoc's going to be one of them, because I loved that candle. And now we just did it again. And we're trending above the 20 with the 20 above the 50, the PPO looking as strong as it has for quite some time. I think this is a stock that's going to go higher. I actually own Teladoc, and I own a little bit of Fastly, although I did cut my position into earnings today.
Okay. ARNC is part of the old Alcoa. So do you avoid too much concentration? For example, the tariff on foreign aluminum is in the process of being lowered or dropped.
Well, I can tell you, and if you've been following my work, or if you remember, you know, I'm not a huge fan of materials and energy stocks. Longer term, I think that, you know, obviously energy's had a big run in 2021. I think anytime you have crude oil prices going below zero, and then they just have a normal bounce back from a ridiculously low level, you're going to see that kind of short-term behavior in an entire group that's dependent on making money from crude oil. I still think the dollar is going to present problems for energy and materials going forward. I think while energy is outperformed in 2021, I would not be surprised if it's the worst performing group in 2022 as we go forward. If I had to make a prediction on what's going to be the worst performer next year, I think it's going to be energy, because a lot of that pandemic panic, if you will, has been now reversed, and we've come back up. And I think, and what I'm talking about here is if you just pull up the price of crude oil. I got to go back further. Let's go back 2 years. So see where we were. Crude oil was, I don't know, $60 or 65. I don't know what that is, back in January 2020. We went down to zero. Actually, for a period of time, we went below zero intraday. This is a daily chart, but I think intraday they were saying that if you had an empty swimming pool, they would actually pay you to put oil in your pool. That's crazy. But anyway, we've already gotten that bounce back, and a lot of the energy companies that were really struggling as a result of much lower oil have been benefiting now from the higher oil. And I think oil can stay where it is. Maybe see it could go a little bit higher. I wouldn't be shocked if it got to $100 a barrel. But I think it's going to begin to stabilize. And so as a result, I think energy will stabilize. Maybe energy goes a little bit higher, but I think the stock market goes higher much more than energy over the course of the next year or two. You know,
when oil hit that, you know, when they were paying to store, I tried to get my brother Steven to agree to load up his pool, but he wouldn't do it. Okay. Has cargo been unloaded on the West Coast? Is trucking up if cargo not unloaded yet?
Yeah, I've had questions. I've had
supply and demand.
What?
It's like a supply and demand thing.
Yeah, I mean, I had questions coming in, you know, how can you be bullish transports when truckers have a shortage of drivers and, you know, stuff's not even being unloaded, blah, blah, blah. Listen, truckers did poorly for a while. The transportation stocks did poorly for a while. It was almost like Wall Street saw that coming and priced it in. What you're seeing on the charts today is what Wall Street's looking at next year, not what Wall Street's looking at today. That's the disconnect between fundamentals and technicals. So listening to news stories about what's going on with truckers, I think you're making a massive mistake if you're trying to trade in today's market using today's news, because the stock market's not trading off of that. The smart money is trading off what's going to be in the news in 3 to 6 months, not what's in the news today. So I tend to ignore stories and I just follow the charts. The charts tell me what I need to know.
All right, let's wrap it up with this one. How about AMBA? AMBA.
All right, I'll look at one chart here. I mean, great move there in September. I believe that was earnings related because I kind of remember adding it to our strong earnings chart list. But remember, when we're picking these stocks, I'm not going to pick a stock on November 10th based on what it did back on September 1st. I'm going to be keeping it fairly close to what we've been seeing here over the last couple of weeks, since what I believe, I believe the start of earnings season is when the banks come out, which I think was on October 13th or October 14th. So every stock that we put in the portfolio is going to be based on just the last 3 weeks worth of earnings reports.
Okay, I think we're good. We've got these, these 3 events coming up. Next week, of course, we're going to have this draft. We got options max pain coming up soon, and then we got the top 10 stock picks. So we'll make sure everybody's aware of all of it. But this is, if there's was ever a time, to give us a try, this is it. Because first of all, this is a very bullish time of the year, even though we've been ahead of it, honestly, for quite some time. Tom has been, I believe, ahead of a lot of folks in terms of the market direction of being bullish and just giving us some great picks. And these 3 webinars, you can sit in on them for no cost, Tom. I think they should just do it.
Well, and the other thing that we haven't even mentioned, but we always have a fall special, and that's coming. We're talking about it, and that's going to be right around the corner. So if you try us now for free, over the course of the next couple of weeks, you're going to have an opportunity to get the best deal you're going to get all year from us from an annual perspective. So yeah, if you are thinking about signing up, I would honestly do it now. Check us out over the next couple of weeks and then take advantage of that, the fall special, which will be an annual deal as we go forward, which will get you some free months. It'll just stick around. It's coming. Let me just say that. All right.
Okay, I think we can go ahead and wrap it up, Tom.
Yeah, I think that's it. So appreciate everybody stopping by. We'll do this again next Wednesday and do the actual draft. But I just wanted to kind of give you all a flavor of what I look at in coming up with these picks. So with that, we will sign off. Appreciate you tuning in, and give us that 30-day trial. Give it a shot. Love to have you. Happy trading, everybody.